US dollars this year so far, basis figures till December 3, primarily due to outflows in the equity segment. Flows under ECB and non-resident deposit accounts moderated as compared to last year. As on November 28, 2025, India's forex reserves stood at a healthy $686 billion US dollars. This provides robust import cover of more than 11 months. Overall, India's external sector remains resilient. We are confident of meeting our external financing requirements comfortably. I will now talk about the liquidity and financial market conditions. System liquidity, as measured by the net position under the LAF, stood at an average surplus of 1.5 lakh crore rupees for the period since the MPC last met in October. Money market rates have remained largely aligned to the policy repo rate, which was 5.5%, amidst comfortable liquidity conditions. G-Sec yields have remained range-bound since the last policy. In response to the cumulative 100 basis points cut in the policy repo rate, the weighted average lending rate of scheduled commercial banks declined by 69 basis points for fresh rupee loans during this period. In fact, the interest rate effect is even more at 78 basis points. The moderation in the weighted average lending rate of outstanding rupee loans has been to the extent of 63 basis points, which again is very satisfactory. The transmission has been very broad-based across sectors. On the deposit side, the weighted average domestic term deposit rate on fresh deposits has declined by 105 basis points, while that on outstanding deposits has softened by 32 basis points over the same period. I would like to take this opportunity to reiterate that we are committed to provide sufficient durable liquidity to the banking system. We continuously assess the durable liquidity requirements of the banking system, which happens due to changes in currency in circulation, forex operations, and reserves maintenance. Going forward too, we shall continue to do so. And after reviewing the liquidity situation and the outlook, as mentioned earlier, we have decided to conduct OMO purchases of government securities amounting to 1 lakh crore rupees in this month. Moreover, we will also be conducting a 3-year dollar-rupee buy-sell swaps this month. The details will be notified separately later today. We are hopeful that these measures will ensure adequate durable liquidity in the system and further facilitate monetary transmission. I would also like to clarify that injection or absorption of liquidity through purchase or sale of government securities under OMOs and that through operations under the LAF, which is VRR or VRRR, which are of short-term duration, serve very different purposes. While the objective of purchase and sale under OMO is to provide or absorb durable liquidity, the purpose, which is long-term, and the purpose of repo operations is to manage transient liquidity, which is of very short nature, so as to align the operating target, which for us is the weighted average call rate or the Walker, to the policy repo rate, which now stands reduced to 5.25%. So it is quite possible that on the one hand, we inject durable liquidity through purchase of government securities under OMO, while simultaneously withdrawing transient liquidity through a VRRR operation on the other hand. I would further like to reiterate that the primary instrument of monetary policy is the policy repo rate. It is expected that changes in the short term interest rates will transmit to various long